Hi, it's Katie.
And Katie, and you are listening to ProperTea, the podcast where we spill the tea on Toronto real estate.
Let's get started.
Hi,
Welcome, everyone.
we're back.
Yay.
We're doing it again. And we have another again. We have Monica Falco here again with us, doing an interview to follow up with our last one, which was, in case you guys forgot, about mortgages. Monica is a mortgage broker extraordinaire. Extraordinaire.
Thanks so much for having me. Yeah, last time was so fun. I couldn't pass up the opportunity to do it again with you ladies.
I'm so glad you're here because, like I said last time, I think I still have so many questions.
And I have so many answers, so I am ready.
So for this episode, my questions are kind of in two parts. So like the first bit is about, I said I wanted to ask more questions about like the tax rates, grants, programs, all those kinds of things, the whispers in the air. And also a little bit about investing and how property ownership can be an investment and things like that. So my first question, Monica, is, like I said, like we hear a lot of things about tax breaks or grants or programs for home buyers, but I really have no idea what they are. So I guess my first part of the question is, what's the difference between a tax break and a grant, if there is one? And the second part of the question is, are there other things like this that I don't know about?
Yeah, absolutely. Okay, so I'll kind of, I guess, go through a few things that are available for first-time home buyers specifically. Tax break, the biggest one when it comes to home buying is the land transfer tax rebate that first-time home buyers have access to. Now, the rebate is different if you're purchasing within GTA and outside of GTA. So if you're purchasing in GTA, you're paying pretty much double the land transfer tax versus outside of the GTA, which, unfortunate for Toronto buyers, but that's just the way it is. The good thing is, they've recognized it. And in that case, the rebate is double if you're purchasing in Toronto. So ultimately, if you're outside of Toronto, you're getting a $4,000 land transfer tax rebate deducted at the lawyer's office. And if you're purchasing in Toronto, you're getting $8,000. So first things first, you have to be a first-time home buyer to obtain that. So that's kind of like the biggest tax rebate. A couple of cool incentives for first-time home buyers. For, let's say, down payment, you can use up to $35,000 from your RSP towards down payment tax-free. Of course, you do have to eventually pay it back. However, you can use that so long as it's been sitting in your RSP account for 90 days, you can use that towards your down payment. So that's great also. And then maybe we can talk a little bit about the incentive programs. So there are kind of two that really stick out. First one, which maybe a lot of people have heard about, is the first-time home buyer incentive program. So it was announced this year, I guess 2020, through CMHC, that this program was going to be available. Now, pretty much the way that it works is the government or CMHC provides you either 5 or 10% for your down payment, in addition to your existing down payment. There are a couple of caveats to this specific program. So the first thing is your household income cannot exceed $120,000. And the maximum mortgage amount is 4 times your income. So if your household income is $120,000, your maximum mortgage amount is $480,000. Okay, so one thing that I've noticed specifically is the majority of my buyers who are purchasing, let's say in Toronto, this program does not make sense for them because, with price points in Toronto, this is just something that is not going to work if you're looking at purchasing even a condo. So maybe this is for buyers who are looking maybe on the outskirts of Toronto with a little bit of a lower purchase price. This is something that we could definitely look into. Again, you have to be a first-time home buyer. And with this specific program, it acts like a second mortgage. So just to kind of give you an example here of how this works. If you receive 5% incentive of the home's purchase price, let's say the home's purchase price is $200,000, that would be $10,000. So that's 5% of $200,000. If your home value increases to $300,000, you have to pay back 5% of the current value. So that would be $15,000. So this is not free money. If you do sell, you have to pay it back. And if your property value increases, you're paying back more money. So that's really kind of how that works.
That's really good to know. That's like a little secret.
Yeah, a lot of people don't know that. They're like, oh yeah, this is great. I'm gonna get some extra funds. I'm like, yeah, it's great, but you're paying back that money as soon as you sell.
Not to mention some of your profits from your house.
Exactly.
Yeah.
So, it's something to definitely think about. And when I'm having that conversation with first-time homebuyers, a lot of people just don't know that, right?
Yeah.
So, sometimes it kind of steers them away because they're like, what if my property increases significantly and I only borrowed 10,000, now I have to pay them back 50,000? I'm like, yeah, like that's how it works. So nonetheless, I mean, that's kind of like the biggest incentive program. There are other assistance programs out there. For example, the city of Waterloo has an assistance program where they offer a 5% down payment for a maximum purchase price of $386,000. Maximum household income has to be $90,500. This program is still available through COVID. I know Hamilton had a program too, which they've discontinued now through COVID. But nonetheless, those type of programs are available, but those are city specific. So some cities offer, some cities don't.
That makes sense. And that actually that clears up a lot of things, because like that, the idea of like a first time home buyers incentive sounds so great on paper, but like, as you pointed out, it doesn't really apply to anyone buying in Toronto, because it's not reasonable to expect that like anybody with a household income less than 120,000 would be able to afford to buy in Toronto, and B, like that's 480, like you said, doesn't exist even in condos. Like that's just not a thing.
Yeah. So keep in mind, it is the mortgage amount. So let's say, you're still kind of around that $500,000 mark, maybe like just over that. So regardless though, like you were saying, Katie, it's, I don't know what you're going to find for 500,000 in Toronto. Like, I mean, these days, maybe like, a 300 square foot condo, if those exist, like a micro condo. But even that, I mean, I personally have not had any, luck placing my clients in this program in Toronto.
That makes sense. That makes a lot of sense. And that's really, really helpful.
Yeah.
So my next question was,
wait, I have one insert question before you go on. So for those of you who are using your RRSPs or money from your TFSA as cash for your down payment, when should you start moving that money out of your RRSPs and TFSAs into your account so that you can have it as liquid cash?
So you can hold on to those funds in your RSP or TFSAs for a maximum of 10 business days prior to your closing date. Doesn't have to be now. The lender is going to want to see 90-day history of those accounts. So your RSP account, your TFSA account, they're going to want to see the withdrawal of the funds from those specific account and then the deposit into your savings or checkings account. So it doesn't have to be done right away. Majority of people want to wait. Maybe they'll be able to get some additional money depending on the time of the year in those accounts. So kind of the rule of thumb that I always say, if you're moving money 10 business days prior to your closing date, that's when everything has to be in your final account.
That makes sense. I actually have another follow-up question, which is we kind of talked about last time. So like, it's not unusual, I think, especially for first-time home buyers and people around like our age, like maybe your parents or like a relative is going to help with the down payment. They're going to gift you some money to do it or not. Like maybe they're expecting like a payback and interest and whatever, but like that's something you figure out with them.
Yeah. That's something we don't talk about.
Yeah, that's something we don't talk about. But so does that mean if that money is gifted and it's in your RSP for over 90 days, like how does that, can you use that money as long as it's been in your RSP for that amount of time and have it be non-taxable?
Yeah, I mean, so long as it's in your account for 90 days, absolutely, you can use the money. I'll be honest, the majority of people don't place gifted funds in RSPs. If it is a gift coming from a parent for down payment, this is something that is so used so often in the mortgage world that it's honestly so easy to kind of do. A lot easier than down payment verification if the money is actually just coming from your own accounts, to be honest. It's pretty much just a gift letter. Every lender has a specific gift letter that they use. So it's a gift letter provided by the lender that has to be signed by the giftor. So that's your parent or immediate family member. And then the money has to be deposited into your account. So they just want to see a gift letter and then money deposited into your account, and they're good.
Okay. They just need to know where it came from, basically.
They just want to know where it came from. Yeah. I mean, it's such an easy process. A lot of people get a little bit worried when it comes to gifts, but it is truly one of the easier ways to verify down payment.
Okay, great. That's great.
And it's something that's so common, as so many people are using gifted.
So many people. I mean, I would probably say 95% of my first-time homebuyers that I work with do get some sort of assistance from their parents. Again, it's just so common that lenders, they understand this, right? So long as we have a gift letter, so long as it's in the account, they're good to go.
We actually did that when we bought our house. My husband's parents gifted us some money.
Yeah, so you can attest to it's probably super easy, right?
Really easy. It was just a letter.
Yeah.
Yep.
There you go.
That's beautiful. I love that. It's so rare that things like this, which require so much like bureaucracy and paperwork, are actually that easy. So
I know. Fair enough. Yeah. No, I totally agree with you. But again, it's about kind of taking the stress off the clients and letting them know, reassuring them that everything's going to be okay. It's going to be a smooth process, stress free. You're going to have someone holding your hand through this, right? So
absolutely. So my next question, minus our follow-ups in the moment, were like, where do these various programs come from? Like I assume, like you said, like the first time home buyers incentive comes from the CMHC, which is Canadian Mortgage and Housing.
Yeah. Yep. You got it. Yeah. So CMHC, Genworth, Canada Guarantee are three biggest insurers. I mean, it always trickles down.
Are they all from the government?
Yeah, so it's the Bank of Canada that kind of, provides these specific kind of programs, and then they trickle down through the insurers. So then the insurers announce it. So like the first time homebuyer incentive program, the one thing that I always say, CMHC is so good with information. Like you can even just go on their website and they have everything kind of like in black and white, A to Z, just kind of spelt out for you, and it's so good. So I mean, if you wanted, or for anyone, any listeners here who want some definitely more information on this, you either talk to me or go on the website, because CMHC is fantastic for this.
Yeah, I agree. I'll attest to that as well. CMHC is a really, really wonderful resource for consumers and for agents. If you're a new agent, CMHC is a great place for you to start looking up stuff, research.
Absolutely.
That actually answered my next question. Also, I have a follow up with this, which is like, are there any like incentives or breaks or benefits that come from the banks ever? Like, are there any programs that banks have that might be specific to your bank and also like your situation, but exist?
Not necessarily for first-time homebuyers. I mean, banks can sometimes come up with like cashback incentives. Really, it depends on the year. If these generally come out, or sorry, I should say time of year. These generally come out in like the spring, summer, when they're being a little bit more competitive. They'll have maybe like a $3,000 cashback on closing, things like that. But it's not like first-time homebuyer specific. Like these are just kind of to get some market share. So the banks in general don't really have individualized programs for incentives.
Okay, that makes sense. And I know that we've talked a lot about for first-time home buyers, but do any incentives exist for not first-time home buyers, for anybody going in and buying a house for the second time?
No.
Sorry, guys.
I'm just being completely blunt here.
No, that answers the question. That's very helpful.
Yeah, not gonna sugarcoat it. No, and it's sad, but yeah, unfortunately there are no additional programs for people who are not first-time homebuyers. These are, first-time homebuyer specific programs.
Okay, cool. Well, check that one off. So, okay, my next question is, because we talked about like, so the land transfer tax is a closing cost. Yes, like that's one of the things on closing that you have to do. So my question was like, what are the most common closing costs, maybe aside from the land transfer tax? And like, do you have an approximate amount that everyone should budget for closing costs?
So most lenders are going to always ask to see 1.5% of the purchase price for closing costs. That's a rule of thumb. They will like most lenders will condition to see 30-day bank statements showing that you have 1.5% of the purchase price towards closing costs. This is outside of your down payment. Now, will your closing costs be 1.5% of your purchase price? Likely not. They may be a little bit lower. They could be a little bit higher, depending if you are getting a rebate for your land transfer tax. However, to answer your question about what the closing costs are, yes, of course, you have your land transfer tax. You will have your lawyer fees. You will have default insurance, HST. If you are purchasing a property with less than 20% down, you are paying HST on your default insurance premium. It's 8% of that amount. So that's something that you have to pay out of pocket also. This is one of the closing costs that a lot of people do not know about. It is like one of those things that are like, I had no idea I have to pay this. And it's not a small amount. The majority of the time it's over $1,000. It's like, it's a lot of money, especially, you know, not knowing about it, right? So it's something that I always, you know, when I'm doing my pre-approvals, I literally write down all of your closing costs. And that is something that is super, super highlighted. That is something you'll have to think about when you are at your lawyer's office. But those are the three if you are buying.
Okay, that's fantastic. Thank you. That's really, really helpful.
Also, I just want to point out that Monica, when you were talking about in your emails with your pre-approvals, when you send all the closing costs, Katie smiled very big and very enthusiastically nodded.
Really? Yeah, I was about to say that was like, I actually knew about these because I got a pre-approval from you. And I find that was like something that was extremely helpful.
That makes me so happy.
Yeah.
I'm pretty accurate when it comes to closing costs when I'm doing a pre-approval, because it's not hard to find what they are going to be. I have a calculator that calculates land transfer tax with or without a rebate. I'll let you know exactly what your default insurance is going to be. The only thing that is kind of out of my realm is what your lawyer fees are going to be, because it's not something I can quote. I give you kind of an estimate from what I see, but that's something that you'll just have to figure out with the lawyer you choose.
Okay, that makes sense.
Yeah.
What do I have next here? I mean, you answered that, because my next question was like, are there any other sneaky fees that come from buying a house that people don't know about but ought to? And I think your HST was
yeah, I think it's the HST. That's probably like the biggest thing. If there's anything else, I mean, maybe like home insurance. You know, it's something that a lot of people don't think about, that they do require home insurance when purchasing property. You're going to need to have that on closing. I mean, it's not a huge fee, and it's not required at your lawyer's office, but this is something that you'll have to pay for to close. So maybe just the home insurance, I think, is just kind of an additional there.
Yeah, so just something else to like factor in when you're doing your budget for all of this.
Yeah, exactly.
That makes sense. Okay, slight pivot.
Part two.
What's the biggest difference between like fixed rates and flexible rates? And are there certain situations where you would say that you would recommend one over the other?
Okay, so fixed rates and flexible rates, and I'm assuming you mean variable rates when you're talking about flexible rates.
Thank you. Sorry.
No worries. Okay. Okay, so fixed rates and variable rates, I mean, yes, they're both offered for every client when you are purchasing a home. I love the variable rate. I'm a huge advocate of it, and I will explain why. There are differences. I mean, your fixed rate, you are signing on to one rate for 5 years. You know, if that's a term that you choose, that's the most common term. So it's one rate for 5 years. Let's say, for example, you sign on 2%. That is what you will be paying for your 5 years. You're not going to have to worry about it. Your variable rate is based on prime rate. So right now, the prime rate is 2.45%. Let's say you sign up for a variable rate that is prime minus 1%. Your rate would be 1.45%. That can fluctuate through your term because, again, it's based on prime. So the Bank of Canada, in a normal kind of situation, looks at prime rate about 8 times a year. And they determine whether they're going to increase prime, decrease prime, keep prime the same. If they make any changes to prime, your rates will also change, meaning your mortgage payments will change. So that's one of the biggest differences. Now, historically, variable rates have been known to be cheaper than fixed rates, just given, how prime rate has fluctuated. The one thing I always kind of have a conversation with my first time home buyers is, listen, what is your plan? Is this a 5-year plan for you guys? Are you thinking you're only going to be here for 3 years, maybe 2 years? Is this kind of like a stepping stone, or will you be here for 10 years? And if you say you're probably going to be only here for, 2 to 3 years, kind of just a middle ground, and then we'll be upgrading or whatever the case may be, go on the variable, because if you cancel your mortgage or if you break your mortgage within your 5-year term, you are paying significantly less than breaking it on a fixed. Your cancellation cost on a variable is 3 months interest. With a fixed rate, you're paying interest rate differential, which can vary depending on which lender you're with. But the majority of the time, to quote, you're looking at a cancellation cost between, $10,000 to $30,000. It can vary significantly depending on the lender. It's more or less like you just have to take a look at what your situation looks like. If you have room in your budget also monthly, if you're you're like, okay, $2,000 is my maximum for my mortgage payment, I do not want to exceed this, go on the fixed. But if you have some fluctuation there, maybe go on the variable. So, it's not kind of like a set in stone answer for any client. It's a very individually based, but this is a conversation that I have with my clients to be like, hey, what does your situation look like? Let's walk through this, because most people are scared of the variable, but until I actually have a conversation with them and let them know what the benefits are, they may want to switch over to a variable. Some may want to stick to the fixed. It's really, really case by case basis.
Okay, that makes a lot of sense, and it's a bit different than it's a different answer than I was expecting you to give me.
Oh, really?
Yeah, because in my head, I'm like, well, probably everybody wants to do a fixed rate, right? Because there's less risk associated with it. But if what the numbers are actually telling you is that in a situation where you may not be sticking around for 5 years, the risk associated is pretty minimal, then that makes sense to me. It makes sense that you would want to do variable instead.
100%.
The potential
I would never,
pay less for a mortgage payment than you expected to.
Oh yeah, you know what? I would never steer my clients in the direction of a fixed if they told me that they were going to sell in a couple of years, because the last thing that I want to see is for them to have a huge penalty to break their mortgage, and that's going to come out of your equity, and that's going to come out of the down payment for your new property, and I don't want to see that happen. So again, it's just a conversation. It's about educating my clients. It's about knowledge, right? And like you just said, Kate, you had no idea that that's what the case was, right? So, learn something new every day.
Yeah. Well, and sorry, a follow-up question that just occurred to me is like, has there ever historically been a time when the variable mortgage rate has like shockingly increased to a point that it's really hurt somebody?
Well, it's always the risk. Prime rate, not this year, but last year did increase quite a bit. I believe it increased 3 or 4 times that year, just off the top of my head. But this year it dropped down significantly. So yes, really all depends on how you look at it. Maybe short term, it could potentially have hurt the client. But that being said, now savings are maybe more because their prime rate has dropped again, right? So, it is about the risk. One thing on the variable too is you can always lock into a fixed. If you get uncomfortable at any time, you can contact your lender and ask them to lock into a fixed. So
nice.
You always have that option.
That's great. So it's not the fix is really fixed, but the variable actually gives you an option to switch.
Yeah, it's flexible, like you said.
Yeah, this is what we were saying last time in the last episode about not getting cookie cutter mortgages, and about how talking to people and coming up with a situation that's tailored to you is so important, because you likely will have so many more options than you originally thought.
Yeah,
exactly.
Holy
Exactly. Who knew?
Who knew? Clearly not me. Okay, here's
I knew
another
some.
pivot. Okay, so we hear about investment properties a lot. So like in your own words, what is an investment property?
Property that makes you money. That's kind of how to put it in simple words. I mean, when a client is talking to me about an investment property, the majority of the time it's a rental, right?
Yeah.
They want to rent the property out. They want to make some money on it.
But
So
based on
that's
your definition, you could look at an investment property as your primary residence as well, because, in hot markets, your primary residence is still making you money in equity.
Oh yeah.
So
I mean,
really,
listen, it's
any,
it's a property in general, exactly like you said, Katie. The way it doesn't matter how you look at it. If you own a property, it's an investment property because you are making money on it just in equity. If you're purchasing another property for rental income, that's an investment property because you're now making money on that property. So, two different ways to look at it. Definitely great point.
Fantastic. So when is the right time to buy an investment property? And follow up, can you or should you maybe buy an investment property before you own your own residence? Is that like a terrible idea?
No, I don't think it's a bad idea. I
agree.
think that having any property, I mean, I'm huge on properties. I'm a big advocate of having them. I think they're fantastic investments. Yeah, I mean, it's it's great to have if you can afford it, of course. When is it the right time? If you have the funds. When it comes to if you're purchasing a property and you're positioning it as a rental property, the one thing that people need to know is that it would be considered an uninsurable mortgage. So you do require 20% down payment if you are looking at using rental income for your qualification. So that's one thing to kind of stress there. Is it the right time to buy a property? If you have the funds, if you have the money to put into it, then yes, it is. If you don't, then perhaps maybe you want to look at purchasing a property to owner occupy, because that's when you can take a look at purchasing a property with the less than 20% down.
Right.
Can homeowners who are interested in buying second properties use home equity line of credits, HELOCs, to buy a second property, like for the down payment or anything like that?
Yeah, absolutely. So if you currently own a property, you can leverage the equity in your existing property for down payment on the new property. With home equity line of credits, the one thing I need to stress is that you can only take out a maximum of 65% of the value of the property. So there has to be a significant amount of equity in the property in order for it to be worthwhile. I do have a lot of conversations with my clients about also refinancing their existing properties, take out money to put towards a new property. That's an option because in that case, you can go up to 80% of the value and take out some significant equity. So yeah, there's always ways to leverage. If you have property right now, use those funds, put those funds towards a new property, and start investing, get a new investment, start making some rental income. It's definitely a great thing to have a conversation about.
Do you think a lot of people use home equity line of credits for this type of purchase, or is this mostly overlooked?
No, absolutely. I mean, if it's available, they definitely do. Most lenders allow you to use, it's called like a flex down. For rental properties, they would require 10% of your own resources, so your own savings, checkings, any like RSPs, things like that. And then the remainder can come from a home equity line of credit. Some lenders will allow you to use the entire amount as borrowed funds towards a new property. I mean, it really all depends on which lenders we are going with. However, if there is a home equity line of credit, the one thing that I always stress is we have to kind of take a look at the qualification. Of course, if we are taking money out of the home equity line of credit, we now have to increase your liability amount because we are including some payments now on your home equity line of credit in your liabilities. So that can kind of sometimes, change qualification and maybe steer clients in a different direction because maybe now, the purchase price has decreased for their new investment property and things like that. So, I mean, it's always something that we can explore. I always like to take a look at all of the options and then kind of figure out which option makes the most sense for the clients.
I agree. So again, not cookie cutter, folks.
definitely not.
Will you do me a favor and explain refinancing, because that is something that I don't understand.
Yeah, absolutely. So if a client has, let's say they own a property, let's say they have an existing mortgage on it, their property has now increased in value, they can take up to 80% of the property in as a refinance. So let me give you kind of a quick example here. Okay. So let's say a client has their property is valued at 800,000. 80% of 800,000 is 640,000. Let's say their existing mortgage is 300,000. They can take up 340,000 out of their property. That's what a refinance is. You're breaking your existing mortgage. You're now increasing your mortgage to take out equity up to 80% of the value.
Okay. That makes sense. Cool. What do I have? Well, I mean, you actually kind of explained this. My next question was, how does owning your own property help with securing a mortgage for an investment property, or vice versa? But like, as like with the HELOCs and refinancing, you've pretty much explained how to do that.
Those are the main two. Definitely refinancing our home equity line of credits.
Hang on one second. I want to take a brief pause for 1 second and go back to a question that we asked, but we didn't really answer.
Okay.
It was, can you buy an investment property before you own your own residence? And is that a bad idea? I actually think, personally, I think this is a really good idea. And it could work in a lot of different scenarios. You know, sometimes you live at home for a really long time, but you make a lot of money in your job or whatever, and you have a lot of cash available, but you don't have a lot of expenses, again, because you're living at home. This would be a good place to invest some money to get a tenant. I mean, you could also move out, but if you wanted to continue to live off mom and dad, buying an investment property and putting a tenant in there is a really good way to increase your net wealth. Or alternatively, if you're paying a really low monthly rent yourself, I know some people who have been renting for 10, 12 years. My trainer, shout out Jen, has been renting her place for 12 years. So the same building for 12 years. So if your rent is really low, you can investigate buying an investment property, sticking a tenant in there, and making money and making the equity. And then if and when you decide to move, or your life changes, or you want to do something else, you have assets, you have leverage, you have things that you can use to make your dreams come true.
I love that, Katie. You honestly hit the nail on the head there, and it's totally true. I've had numerous clients that have done it. It's just a matter of, I think the biggest kind of hurdle is definitely down payment. But if you have the funds, I think that investing in real estate, it's always a smart decision. You're getting equity, your property's increasing in value, you'll get a tenant there, you'll pay, they'll help you kind of cover your monthly expenses. I think it's always a great idea.
I agree. And I think even if you end up paying, a couple hundred, like if you put a tenant in there and your tenant covers most of your expenses, but you're still out of pocket, $200, $300 every month, you're still making money on the equity. You're still, you're still way further
You're still
ahead.
winning.
Yeah, you're still absolutely winning. 100%. Yeah. So look into that. If that's your situation and it sounds interesting to you, I think it's definitely worth exploring.
Yeah,
for sure.
So the next question was, and we may again have already kind of covered it, but do you have any advice for a first-time investment property buyer that we maybe haven't covered so far?
I mean, I think the only advice I would have for a first-time home buyer is kind of take a look at cash flow. I think that, it's always important to take a look at what's important to you. There are some, clients who really just want, if they're investing in something, they want it to make sense. They want their expenses to be covered. They want their mortgage payments, their property taxes, utilities, things like that to be covered by their tenant. And some clients, they have a buffer, right? I think it's just a matter of, my advice is to ask questions and kind of, keep an open mind to other things, because if you are purchasing in an area such as Toronto, the increase in property value is pretty significant. So even if you are paying maybe 100, 200, whatever amount per month, extra out of pocket, you're still, again, your property is increasing in value. And that's kind of, that's where your investment is kind of being held. And that's pretty much, where you're going to walk out a winner, as I mentioned before. So, I mean, I think that the biggest thing is definitely just ask the questions, right?
Yeah, for sure. So, and is like, what's the difference between, because I mean, we're talking like, as you both have mentioned a million times, real estate is a really consistent and smart investment. But in any situation when you're investing, there can be safe investments and risky ones, I assume. So what would you say is the biggest difference, or maybe a couple of like red flags between like a safe investment property and a risky one?
Good question. I can only really talk about the mortgage side of things.
For sure.
I think that you guys can definitely maybe talk a little bit more on the realtor side of things. A risky investment property is generally one that, let's say I'm having a lot of conversations with clients about people who are looking at renting out basements. That sometimes can be risky, especially on the mortgage front. And I want to explain why. If you are looking at purchasing a property with a basement apartment, it has to be legal and retrofitted in order to use rental income for qualification. So a lot of people don't know that. A lot of people purchase these properties thinking that they can use rental income, and then the lawyers take a look at things deeper and they can't. And then that kind of, puts us in a little bit of a tough situation. So I would probably look at that being more of a risky situation. But truthfully, I mean, there's no really big like red flag between a safe or a risky in the mortgage side of things, except for, as I just covered. But maybe you guys can touch base on it, maybe on the realtor side. I think there'll be a little bit more information there.
Yeah. I mean, when it kind of goes back to the due diligence again, and also knowing what your client's motivations and goals are. If it's something that they're going to turn around in a year or 2 years, then there are going to be properties, even investment properties, that you're going to completely steer them away from, versus if it's something that they're going to hang on to for 30 years, you might be able to look at some slightly pricier options because, you're going to hold on to it for a lot longer. So, in terms of the real estate side, it's about doing due diligence, making sure that you're not obviously super overpaying for something, and doing all of like, the standard due diligence that you would with, if you're buying a condo, checking out the status certificate, making sure, checking out what the market is in that neighborhood, and making sure, checking out the historical increases and that kind of thing in the neighborhood to see if what projections would be for the next 5 or 10 years. So there are certainly lots of things that you can do from the real estate side to mitigate risks when you're buying a property. But the biggest and most important thing to do is to be really crystal clear on what your goals are with your investment property, and communicate those to your real estate agent and your mortgage broker so that we can come up with a plan that works for you.
Absolutely. I think that, you really touched base really well on all those points. I've seen a lot of things, especially in Toronto, you may hear of Kitech plumbing. You may hear of, status certificates, which are not in the greatest shape. We take a look at all of these things before purchasing a property. And even, when you're taking a look at on the real estate side and the mortgage side, some of these things really coincide together. And one of the things is, as Katie mentioned, status certificates, if there is an issue with the reserved funds, that's something that we'll always kind of take a look into, because that can affect financing. It may not be a big deal for the client, but it may be a big deal for the lender. So that's something that we'll take a look at ahead of time. Things like high-tech plumbing, you'll see a lot of this in buildings in Toronto. Lenders are not a fan of high-tech plumbing. So if that's included in the status certificate, reserve funds may be fine, but high-tech is there, again, we may run into an issue. So, it's all about the due diligence. It doesn't matter whether you are renting out the property or living in the property, it's all about the due diligence. And we do this all ahead of time so that your closing process is as smooth as possible. We're not going to run into any issues.
That makes sense. Also, just for our listeners, the Kitech plumbing, correct me if I'm wrong, but it's a type of pipe that went into like a number of condos downtown at like a specific time, and it tends to be pretty faulty. I think it breaks a lot.
That's exactly what it is. Yeah.
And
It's
I'm
caused a
here
lot of
like,
flooding.
Putting my hands in my head in my hands. I'm like, oh my God, this is so
It's a
triggering.
headache. Yeah. And it's triggering me right now too, because when I hear Kitech plumbing, I start sweating.
No, you're like, your eye just immediately starts twitching. You're
I'm
like,
like, oh my God, what?
that's a good thing for everybody to know about. Like if you're interested in investing or even renting a condo, like keep an eye out for that, because it does ultimately impact you if the plumbing is breaking constantly, whether it's impacting you because you have to leave your apartment because it's flooded while your landlord gets it fixed, or if it's because you end up having to pay into that and there aren't sufficient funds from the building because they didn't factor in faulty plumbing when they were building it. And it is fairly common. So like
yeah,
that's
there was a period of about 10
that.
years, I think, where it went in pretty much every building, or a lot of buildings. Like
Yeah, it was the early 2000s.
yeah.
And a lot of buildings were built in the early 2000s. I mean, a lot of buildings in Toronto have had these remediated. A lot of lenders will say that they, if there is Kitech plumbing in the property itself, they'll ask maybe for a holdback to confirm that the plumbing has been fixed. So a holdback would be kind of a holdback of mortgage funds. They would then confirm with the plumber that everything has been fixed, and then they would release the funds to the client. Certain things like that, it's things are still doable, but lenders have a different appetite for these type of risks in their end, because if a condo floods, that'll be a problem.
Yeah.
Yeah, for sure.
Not to mention, like on the lending side, but also insurance. It's hard to get
Oh, yeah.
insurance for a lot of, buildings with
Yeah.
Kitech or
Yeah. And this is why we do the due diligence ahead of time.
ahead of time. Yes, we want to make sure this is how we prevent you from buying risky investments.
Exactly.
Beautiful. Okay, here's a relevant question. How has COVID-19 affected investment or residential properties here in Toronto? Like, what are you, from the mortgage side of things, what are you seeing that's maybe COVID specific right now that it would be helpful for consumers to know and understand?
Yeah, absolutely. So, I mean, it's unfortunate everything that's going on. And first and foremost, I want everyone, to be safe and healthy. And I hope everyone is doing well that's listening to this podcast. But yeah, things definitely have changed. I mean, it is a, unprecedented time. I'm sure we've heard this a lot this year, but
Yeah.
lenders are kind of taking things day by day. Nothing is in writing in underwriting policies for a pandemic. So where they're pretty much going day by day, case by case with clients. The one thing that a lot of lenders want to know is whether your income has been affected because of COVID. Some lenders won't use your full salary for qualification. Some lenders will. These are things that we talk about ahead of time to make sure that if I am, or when I'm providing, sending your application for approval with a specific lender, we're not going to have an issue with income. Lenders are being extremely diligent with pay stubs. Back in the day, you provide an employment letter, pay stub, and your closing date is 3 months away. It's satisfied. We're good to go. Now they can ask for updated pay stubs up to 10 business days prior to your closing date. So, they're just being extremely diligent when it comes to income. They're calling employers to verify. It's just kind of like you have to kind of go with the flow these days. And that's how I always explain it to the clients. I have, back in the day, it wouldn't be this more of a stressful document heavy process for clients, but now it's more or less like if they're asking for documents, we kind of just have to go with the lender, see, mitigate any sort of concern that they have and take it from there. And this is why you need someone on your side, because if you would be dealing with this with the bank, it probably would be significantly more frustrating and stressful for you versus, having me being the middleman and mitigating everything for you. But then the only other thing that I would maybe say is turnaround times. Turnaround times on the mortgage side have been crazy long. I mean,
oh God, yeah,
crazy long. think long that again, there's Kai Tech makes me sweat and turnaround times makes me sweat. So it's just a matter of patience, because, the reality is the majority of people who work for these companies are now working from home. So they're all in the same position that we generally are in right now. Things are slow. So patience is key during these times. And this is why getting documents ahead of time is also key, because we don't want turnaround times to have a negative effect on getting your mortgage financing.
That makes a lot of sense.
Turnaround times.
But good news is rates are really low.
Rates are really low. Rates are great.
Rates are really low. Yeah. So let's turn this into a positive. This is a fantastic time to buy because rates are crazy low. I have not seen these rates this low for like at least 4 years. It's been nuts. It's crazy.
Would it be a time to maybe get a fixed mortgage because the rates are so low?
A lot of clients are going into a fixed rate mortgage, but a lot of clients are going on to a variable. I mean, right now I have a variable rate of 1.35%.
What? That's even lower than the mortgage rate right now, right? Like the fixed rate?
It's crazy low. Like our fixed rates right now, 1.54. Like, it's still super, super, super low. So I mean, great time to buy. I think, although there are all of these caveats in place and whatnot, I mean, it's still, so long as you have a good team behind you, it's going to be smooth sailing. Nothing to worry about. You can lock in a good rate and pay crazy low interest rates and monthly mortgage payments. It's great.
Word. My last question is irrelevant. Because it was, are there benefits for property investors a la the first-time home buyer grants, which is a different way of asking a question that I asked earlier, and that also was already answered with a resounding no. So this is never mind about the last question.
Okay, wait, I have a different last question, sort of more regarding COVID-19. So we talked about how it's affecting Toronto. Are you seeing, like, up in cottage country, for example, kind of what's the impact out there? Have you seen anything? Because I mean, like, market wise, it's going like crazy.
Hotcakes.
Cottages, I have seen more cottages this year than any year,
Mhm.
and then any year in my business. And it's because so many people do not want to be at home, or so many people are now being like, okay, it's a perfect time to get a second property because we can't travel right now, so let's get a cottage. It's not affecting in regards to like underwriting cottages. Nothing has been affected. It's the same kind of situation as I previously discussed. However, a lot of clients are now purchasing cottages as primary residence because they can work from home. So, purchasing at 5% down or your minimum down payment, it's happening now with cottages. So, that's pretty much the only really big difference that I've seen, is just because a lot of people, again, have had confirmation from their employers that working from home is fine. So lenders are now okay with it. So, I mean, again, case by case basis, but that's truly the biggest thing I've seen with cottages this year.
Yeah.
Ooh,
I think
actually,
this working from home thing is gonna stick around for a while.
Oh yeah.
My follow-up to that is because I didn't ask this before because I didn't know to. What is the biggest difference between like buying something as a primary residence versus a secondary residence? That's not an investment property, right? Like your secondary residence is still a place that you own and live in. So,
well, I mean, it's pretty much the same type of qualification. If you're purchasing a secondary property, you can purchase it with less than 20% down. It's still an option, so long as it makes sense. If you're purchasing a property that's like over 2 hours away, then they can, lenders will be like, yeah, okay, this is a secondary property. But if you're purchasing a property that's maybe 20 minutes away, they're not going to look at it that way. So, so long as it makes sense, nothing has really changed. Secondary properties purchase, you could still do it as an owner occupied investment. It would just be an investment property as a secondary residence. The only really difference is, of course, you would just have to qualify without any additional rental income support.
Right. Okay. Yeah, that makes sense. Cool. I mean, I got nothing else. Is there anything you'd like to, as long as we have you here, is there anything that you'd like to share to the community at large? Anything that you've like noticed or that you just want to shout out that has maybe nothing to do with any of the questions that I asked?
Yeah. I mean, shop local.
That's true. I love that.
Yeah, I mean, if I can shout anything out right now, we're recording this on November 24th. So we're right around the holiday season. Shop local. That's the one thing that I can say, because I'm a huge supporter, and you know, it's really sad to see what's happening in Toronto. But I think with, you know, if everyone kind of comes together as a community, it's going to be a good holiday season, I think.
I agree. I think so too.
That was so sweet. It's not at all what I was expecting.
Aw.
Not because I don't think you're sweet. I just thought it was going to be like mortgage related, and instead it was like,
No, who cares about
wholesome and
mortgages?
endearing.
I'm just
This is
joking.
why we love Monica.
No, I love you guys too. No, you know, I'm always happy to chat mortgages with you guys. It's always it's a blast. It's truly a blast. I love it.
Sure. We love having you. So
too.
that's good.
Thanks.
Monica,
All right,
thank you
ladies.
very, very much for joining us today. We really appreciate your insights as always.
And
Well, thank you so much
guys,
for having me.
don't forget to go to mortgageswithmonica.ca or reach out to her on Facebook or Instagram. Remind me your Instagram, Monica?
Mortgages.with.monica.
Beautiful.
Spelled MONICA.
Important point of clarification.
Thanks so much, ladies. It's always a blast.
Awesome. Thank you.
Bye.
Bye.
You've been listening to ProperTea Podcast.
Thanks for tuning in. And don't forget to like and subscribe and follow us on all of the platforms.
And remember, if you have any questions about anything we've discussed on the podcast, or you want us to discuss, DM us on our Instagram at ProperTea Podcast. That's ProperTea Podcast.
See you next time. Bye.